Okay, part two of the life insurance chapter. Um, we'll start talking a little bit about variable life insurance, and quite frankly, we don't need to talk too much about it. It's very similar to universal life. Essentially, in this case, the one of the differences is that in this case, you're actually going to be able to choose what kind of investments the separate individual accounts go to. So those choices could be, they say equity mutual funds here, or fixed or mutual fund accounts. They're really kind of pseudo accounts. They're not. They are mutual funds, but they are. For instance, if you bought a Fidelity Magellan account through a variable life insurance policy, you don't really get Magellan. You get something that looks like Magellan. And of course, you're going to be responsible for ultimately the cash value of this policy. So whoever the policy holder is obviously has to have some investment experience. Another, I guess, difference, it's a technical difference, but a regular old life insurance salesperson cannot sell variable life. You can only without a securities license. So since there is investment risk involved here, you have to have a securities license in order to market and sell variable life. But again, it's the same kind of stuff. You have all the expenses associated with the universal life, but now you also have other expenses attached to the mutual funds. So they're even more expensive than universal life. A lot of different types of policies, I guess. You have first to die policies. It pays on, you're really paying on two persons, but it pays off when the first person dies. And then, of course, it's done. You could have second to die policies. When the first person dies, there's no benefit. It's when the second person dies. Again, the pricing mechanism for those are a lot more complicated. One of the things I do like to talk about, though, is really the need for insurance for family members, and quite frankly, I think hopefully you're aware that you need to have some spousal insurance, even if you're a stay-at-home parent. What happens if that person passes away? Who's going to who's going to make up the cost of taking care of the children if that person passes away? So there is a need for spousal insurance. There's also a need for insurance for your children. I mean, you need to have something, God forbid, something should happen, and they pass away. You need to have some money to help with at least with the funeral arrangements. You don't have to have a lot. We're only talking about maybe $10,000-$15,000. But I mean, one of the things that I tell people is like, look, I mean, how many days do you get for grievance? If from work, they're only going to give you maybe 1-2 days. If your child dies, you're telling me that you're going to be able to go back to work in 1 or 2 days. You may need a little bit of money, at least to get, a couple of days under your belt, so that you can, before you get back to work. So again, there is a need. We'll talk a little bit about the contracts. I mean, obviously, it's a complicated document, certainly written so that the average person can't really understand it very easily. But there are some important things that we need to talk about. The ownership clause. Who actually owns this policy? Well, usually it's the person that's paying the bill. So if you're paying the bill, then you're the owner. If your business is paying the bill, then they're the owner. The importance of this is, when you pass, is it included in your estate or not? If you are not the owner, then it's not part of your gross estate. Grace period. Typically, you're given up to maybe 10 days to make payment on the premiums before it defaults. Non-forfeiture is an interesting clause. What happens to the cash value if you quit making payments? Well, a non-forfeiture clause basically says that you don't forfeit that money, that you want it back. So it's just a document that tells the insurance company what to do should you stop the payments. What do you do with dividend options? What kind of options are there? We're going to talk about dividends in class, so I want to kind of leave a little bit that to go, but you get to choose what to do with the dividends. Do they send them to you? Do they keep them in an account to earn interest? Do they buy more insurance with them? What about how do policy loans work? Right? All of these things have to be designated or talked about within the contract itself. There are also things called riders, and a rider is essentially an additional life insurance policy. It covers a specific kind of need. So there could be an accidental death benefit. So if you die by accident, some kind of an accident, obviously separate that from you die from an illness, all right, or you die from old age, then this would pay a benefit in addition to that. One of the more popular things are the waivers of premium. So that if you get sick and for some reason you can't work for a certain number of months, then this will pay for your premium so that your policy doesn't lapse. I always like this one, guaranteed insurability option. I mean, basically it's an insurance policy that says that if you want to change your policy in the future, then you don't have to show insurability again. You already did it in the beginning. Now, one of the things that I want to bring up, since these are all insurance policies, they all cost more money. So there is a fee for all of these. I want to talk a lot about loans. It's a very complicated process. It's really a tax question, not really an investments or a financial planning question. But I mean, here's the net impact. If you borrow money from this policy, it's coming out of your cash value. So it's going to reduce the death benefit that you receive. However, when you pay it back, you're going to be reducing that amount, and the money goes back into your cash value. But while it's out, you pay interest, and you don't pay interest to you pay interest to the insurance company. So if you don't pay back the loan, the insurance company still wants their interest. If you don't pay and you don't increase your premium, then ultimately this interest has to come out of your cash value, and eventually it will lapse. It will go to zero. You'll have zero cash value, and it will lapse. In fact, it could lapse before that. I mean, if you have a rule that says that you can't borrow any more than I don't know. Let's say you can't borrow any more than 70%. Once you get to 72%, it actually will lapse, even though you still have cash value in there. What about options of settlement? What happens when you get distributions from life insurance policies? Well, kind of depends on who gets this policy, and in the end it kind of depends on when they get it. So we're going to talk about some basic options themselves. You can get a lump sum distribution. That is, you're going to get the whole policy, and again, at death, this lump sum payment goes tax-free to the beneficiary. If you decide that you want the payments to go to this to your beneficiary, then you could do it and set it up so that it's as a fixed annuity. For instance, they get money for a fixed period of time. Now, what happens when you make these choices of this annuity piece is the control of the money actually goes to the insurance company. So now they have control. So they're going to move this, since they're going to tell you how long they're going to pay, they're going to move this to a lower returning policy as far as returns. So you could do it for a fixed period, you could do it for life, you could do it so that you get a fixed amount of income. But again, this process here is just say, well, how is the distribution actually occurred? Is it in a lump sum or is it in payments? The annuitization process, we need to talk a little bit about that. It's the process of converting a lump sum into some form of payment stream. lots of people come across this, not necessarily even from life insurance, but when you get to retirement, right? One of the things you're going to do, let's say at retirement you have $1 million in your company's retirement account. Well, your company wants you to take that $1 million out. They don't want to be responsible for it, so they want you to withdraw it. Well, what do you do with the $1 million? Right? How is it going to be invested? How's it going to work? Well, you can go to an insurance company and you can purchase something called an annuity, and they will then make those payments to you. So let's again talk a little bit about that process. Once the insurance company insures the payment stream, then you lose control of those assets. So what if you do payment for life? Say, look, I want you to figure out, what will you pay me every month for life? And they say, we'll give you $1,000 a month for the rest of your life. What happens, again, let's talk about $1 million. What happens if you die in 3 years? They've paid you $36,000. The company has the remainder of the $1 million. What happens to that money? Well, if you die in 3 years, then the insurance company gets to keep the rest. What if it's a period certain, right? The company guarantees a certain number of payments, let's say 10 years. Well, if you die in 15 years, whatever's left over is going to stay with the insurance company because they've exceeded the 10 years of their guarantee. But if you die in 5 years before the guarantee amount, they would pay the beneficiary the amount that would have been received for the 10 years. But again, they still keep whatever else is the excess. So moving to an annuity is really not something you really want to do, especially if you have health issues. Again, let's talk a little bit more about the taxation piece. If it's a distribution upon death, it's usually not taxable. Typically it goes to a beneficiary, and the beneficiary gets it tax-free. But what about distributions during life? Again, we're going to talk about dividends in class, but dividends are not taxable. The loans that you take, a loan could be taxable. It depends on the circumstances and the amount of the loan. And in the end, what happens if you cash out a policy? Again, it is a taxable transaction, but most of the time you're actually in a tax loss situation, so you won't necessarily have to pay taxes. This is one of the ways that cash value life insurance guys try to suck you in to keep you from transferring or going to another company, because they say, oh, if you cash out, that's taxable. And it's true, it is taxable. However, in the end, because of the math, usually it's a non-tax event. The tax that you calculate is zero. Life insurance and estate taxes, again, if you're the owner, that policy will be in your estate. So it's in your estate, but if it went to a beneficiary, the cash is not in your estate. What about switching life insurance policies? Switching from, again, they refer to it as replacement. If you go from cash value to cash value, especially within the same company, that could be a sign of churning. Quite frankly, this is why if you go people, I can just tell you my own personal experience. I came up a family, husband and wife. They had 2 kids. Actually, I'm sorry, they had 3 kids, and in the end, they had like 12 life insurance policies. Why did they have 12? Well, every time they had another kid, they increased 2 life insurance policies. So they couldn't take their current cash value and move it to a bigger cash value because of the fees and the things that are associated with creating one of these contracts. That's actually referred to as churning. So if you go from term to cash value, it's really convertible, right? And this is not really a switch. The life insurance industry really likes when you do that. So there are no big issues. But if you do go from cash value to term, there are some special reporting requirements. And quite frankly, this is set up because the life insurance industry wants you to have permanent insurance, not term insurance. Permanent insurance is the profit-making insurance. Term insurance has a very low profit margin. So they want you to stay with that